Okay, today we are going to talk about the tax implications of owning a rental property. This is a space that has a lot of misinformation, a lot of just garbage advice going around on the internet. So it's a good idea to kind of break it down. We're going to do this in multiple parts. This is part one of maybe 1,000 parts. I have no idea how many of these we're going to do. But basically, today I want to talk about first the steps of purchasing the rental property and kind of getting it operating and what that means for you for your tax situation. So first, you buy the property. So I buy a $150,000 property. Part of that purchase is for the land that the actual building sits on. Another part is for the actual building. That's important to distinguish those two things when you buy the property. It's common to see about an 80-20 split, depending on what area you're in and what the actual property looks like. But you should base it off of things like property tax records and things like that. The reason that's important is because land is not a depreciable asset. Land has the same value and it holds that same value over the life of the property. The building gets depreciated over time, so that's something we're actually going to take a write-off on as we go throughout the life of the property. So super important thing that a lot of people forget to do. So once you've got that down, you get a tenant in place, you start collecting rent and you start paying expenses. Basically, all you have to do when you own a rental property outright, just individually or through a single member LLC, we've got to put together a profit and loss statement on our tax return. Profit and loss statement is basically we summarize our rental income from our tenants, and then we subtract from that any applicable expenses, which is going to be like mortgage interest, real estate taxes, utilities, repairs and maintenance, anything else that you can think of that's relevant to that property specifically. You're going to deduct that. And we're going to be left with either a profit or a loss. If there's a profit, we get taxed ordinary income taxes on that. So if I'm in the 22% marginal bracket with the rest of my other income, that's what I'm going to get taxed on. Is basically if I've got a $10,000 profit, I'm paying $2,200 in federal taxes. If I have a loss, I may be able to deduct that from my taxable income and reduce my tax liability, but not necessarily. That's another thing we're going to talk about in a future video. So we've put together all of that. Here's two of the most common misconceptions with just those couple of processes there. Number one is people always think that they can just deduct their whole mortgage payment, but you can't. Basically, you have to split out your mortgage interest and real estate taxes and anything else that's worked into that mortgage payment. Those are the ones that you can deduct, but you cannot deduct the payment for principal on your loan, because essentially you've borrowed money and you're paying that down. That's not technically a write-off because you didn't recognize income when you got the loan. So that's number one. Number two is depreciation. Nobody seems to understand this. So depreciation is basically we're writing off the value of that building over a period of time that the IRS allows. So the IRS basically says for residential real estate, you write that off over 27 and a half years. If it's commercial real estate, it's 39 years. So really weird numbers, but that's just what they came up with, and it's been that way for, I think, as long as I've been alive. So basically, if I've got like a $110,000 property and it's residential real estate, 110,000 divided by 27.5 is $4,000 a year in depreciation. So every year when I put together my Schedule E, which is where I report the profit and loss from the rental property, I'm going to deduct $4,000 of depreciation. It's not something that I'm actually moving money and paying. It's just part of owning that building and paying down that mortgage. The cost of what I paid for that building, I get to deduct over an extended period of time. It would make no sense for us to write off the whole building in the year of purchase because it obviously still holds value over a period of time, which is the whole hope behind owning one. So those are the two most common ones. We're going to get to passive activity loss limitations, 1031 exchanges, cost segregation studies, all that good stuff. So stay tuned for that.